And welcome. We have the absolute privilege of being here today with Suzanne, our Chief Investment Officer. For those who don't know me, I'm Kat. I'm our Chief Member Officer. And today our job is to have a chat around what's going on in markets. Now, if you'd like to learn more about our performance over the last financial year, Suzanne's done a wonderful video that's on our website. So please go to the website and check that out. Today's chat is about the things that are shaping what's going to happen in the future. And Suzanne's going to give us her crystal ball, aren't you?
I'll try.
Look, there's lots going on, and it's been fair to say it's been a bit of a year.
It has. It has been a very surprising year.
Yeah, there's a lot of themes playing through, but I think there's two really big ones that we want to touch on now. And it's been on everybody's mind. It was a thing. It's not a thing. It's now a thing again. The Middle East. Tell us what's going on.
Yes, and it is surprising, and investors, I think, quite rightly, are somewhat confused. We saw a setback in share markets in March when the conflict began. But a very rapid recovery. Share markets recovered very quickly, even though oil prices did stay quite high for some time. And we're seeing a resurgence in conflict now and high oil prices again. But it is surprising that share markets are at their highs, mainly because investors have been willing to look through the impact on inflation as temporary. It will take some time to become apparent as to whether that is really wise or not, but we will see. But looking through that impact on the potential impact on inflation has been helped by other areas of support for share markets, particularly the performance of technology companies and the earnings that are coming through in that part of the market.
And you'd have to be living under a rock right now to have not heard AI about a gazillion times, right? And that's
Absolutely.
what you're talking about.
Yeah.
It's this once in a lifetime or at least generational change to technology. And what's that doing to markets?
Yeah, there's a lot of conversation about the impact because a small number of companies that are perceived to be the winners from AI are really holding up the share market and driving it north. And that really is what investors are trying to do at the moment, sort through the winners and the losers from AI and this technological change. But it's all an exercise in trying to fathom the future, the expectations of what the impacts will be. If I give you some examples, that might help. So one part of the market, the software companies historically were seen as some of the strongest companies around to invest in. Fantastic business models.
Household names,
barriers to entry, necessities. But not anymore. Software and application businesses are seen as being replaceable by AI. You can get AI to do that. So it's not the type of resilient business model that investors once thought that they were. And the big winners have been the AI providers, right? The AI providers are seen as the companies that will generate and capture the revenue, the revenue from this new technology and the way that it's utilized. There is some concern about the amount of money that needs to be spent on infrastructure and building the things that have to be built. But the share prices of those companies have gone up so much. But recently, it's been the semiconductor names, the chip names, that have seen outstanding performance and really propelled the market higher. There is an index of these semiconductor and chip names, as there is. There's an index for everything. And I think it's a really good example to just reflect on the fact that semiconductor index just last quarter went up 110%, and in the last couple of weeks went down 25%. So the volatility we're seeing from shifts in expectations is really huge,
Yeah, and I think if I can play back to you what I've heard, just and you can tell me if I've got it right or not, there's some really important concepts here, I think. Number one, what I heard is this concept of look-through. So investors are always trying to figure out not what's happening today or reflecting on what's happening in the past. They're trying to predict where the value is in the future and they're looking long-term ahead. But there are some things that are unusual right now. AI is a once-in-a-lifetime change, and we have to be really careful over what is hype and what is real, and you've got no playbook to know what is actually going to happen with this. None of us know where AI is going right now.
Absolutely.
And there is a risk also in that concentration of only a small number of stocks going up, especially when we're in the game of diversification and investing for the next 20, 30 years.
Yeah, that is right. And that certainly is something that investors are talking about a lot, is this concentration. So, what does that mean? It means what that refers to is a small number of companies with a particular thematic becoming an increasingly large part of the stock market.
Right.
And why could that be a concern? Well, it could be a concern if that increasingly large part of the stock market, if the future earnings is less certain and could shift. That is a potential source of risk and a lack of clarity about what things are really worth. Yeah. So that concentration has been spoken about a lot, as has the other consequence of that concentration, which is difficulties in valuing and selecting companies. So we're believers in active management, and we have specialist managers that select companies and build portfolios. If you don't have the right amount of those particular names that are capturing performance, then it's hard to beat the index. It's hard to match the index. Yeah.
Well, I'm thrilled that we have a team that are obsessed on this and that you are at the helm of that. So thank you for explaining those. There's lots going on in the world, and I know that in our job, we really do need to think about what does the future hold, right? So investors are not only thinking about what's going on today, but we're thinking about what's going on in the next foreseeable period to try and generate returns for our members. So get your crystal ball out for us if you can. You know, what are we expecting over the next sort of 12 to 18 months?
Yeah, it's really important to reflect on. We spend a lot of time thinking about the forward-looking environment and what it holds, because we need to build investment capability and investment decision-making frameworks for the forward-looking environment, not for the past. And we really think the future does look different to the past.
Okay.
We had a decade or two that had uniform environments, pretty low inflation, but strong growth. And that environment we don't think persists into the future. We're seeing things in the world that suggest something different. We're experiencing a lot of trends that relate to national security and self-sufficiency and local production. And they're the sorts of themes that are really, really strong on investors' minds, because although some of them relate to national politics and geopolitics, they have economic implications. So, we think that the forward-looking environment is a world where inflation is higher and more volatile. Another key characteristic of that environment is unless there's an economic downturn, it's hard for central banks to put interest rates down. So it is most likely a higher inflation and somewhat higher interest rate environment that we're looking at heading into. Now, that's not a poor environment for investing. That's not our conclusion, but it is trickier and most likely more volatile.
Yeah, no, that's fascinating, because I think there's the members who are with us are probably thinking high inflation and high interest rates. That's tricky for them. So it is a tricky environment. But what I'm hearing very loudly is from you is from an investing point of view, there's still going to be plenty of opportunities and their super will be working very hard for them.
Absolutely.
Wonderful. Thank you.
Thank you.
We do have a world, I guess, where lots going on. The future feels a little bit tricky, especially from a member's perspective, but there's lots of opportunity from an investment perspective still. Can you talk us through how you're approaching that with the team?
Yeah, absolutely. Absolutely. And I think our members can take great comfort from understanding our investment strategy and our overall approach to investing. We are believers in active management. We do everything actively across the portfolio, which means we're selective and we deliberately choose everything that we invest in on behalf of members. Another really core part of what we do is diversification. We're very strong believers in having lots of different elements in the portfolio that perform differently at different points in time. So the more diversified you are and the more levers that you have, the more you can deal with the environment that comes at you. We are more diversified than many of our peers. We have 10 asset classes, new ones we develop, and we're constantly looking at the capabilities that we need to deal with the environment that we're in. So we're about delivering consistent returns over time. It's not that we don't believe that strong long-term returns aren't important. They're critical, and that's what we've always delivered for members. But the journey is important as well, smoothing out the bumps and bruises. So that's a core element of what we're focused on.
I think that's super important because, members online, you don't know. Every individual will retire at a different time. Things are more important to different members at different time, but you're actually thinking about the whole portfolio. How does the whole portfolio deliver for every human? So we do need those smooth returns over time, don't we?
We do. It's important. And the environment that we believe we're moving into with, somewhat higher inflation and interest rates that stay a bit higher than we've seen in the past, there's a lot we can do to work with that. So there are investments and asset classes that can perform quite well in that type of environment. Infrastructure is one, commodities, some parts of property, and some types of shares also do very well in that type of environment. But we think thematically as well about the way the world is changing. Where are there tailwinds for particular types of investors, and where there's structural support? That's really important. We think asset allocation will be very important in coming years. And we think having a diverse range of defensive type of investments is also going to be really important. We've spent a lot of time building up our alternatives program, particularly given there's the prospect that traditional fixed income, might not deliver the sorts of returns and defensive characteristics we need. So we need to make sure that we can get that defensiveness from lots of other parts of the portfolio.
Yeah, that's great. So if I can play back to you what I've heard again, just so that if it makes sense for members, we take a very active approach to our asset classes, not only in the asset class development and how we actually think about the whole portfolio, but then the assets within each of those things. So we're very active. We're thinking about where the best value lies for our members. We're highly diversified. And I'm just really pleased that we have Suzanne and the team thinking about all of that, and that you do get to trust your super with CareSuper.
Absolutely. Thank you, Kat.
So as always, we love hearing from our members, and we often get questions through. Some of them are a little bit trickier than others, and I think this one is a really, really curious one. We have been getting lots of questions around private credit. There's been stuff in the news about things not going so well, but I think the point we would love to talk to is, when would we use private credit versus what people have been hearing externally?
Sure. Thank you, Kat. And there is a difference. So when we think about private credit, we incorporate that into our overall credit asset class, but that asset class is incredibly diverse. It has liquid credit, so publicly traded credit, all sorts of different types of instruments from sectors around the world. So it's incredibly diverse, and we're very careful about the due diligence we undertake. We have specialist investors that are experts in their field in each of the different parts of the credit market, and we really carefully balance the liquidity of the overall asset class as well, and think very carefully about what it's going to deliver our members and what's an appropriate way to structure that. What is really important, I think, is balancing the exposures in the right way, but also thinking about how you make the investments. So we typically do that through direct mandates and have a lot of control over the investments that we make, and we can modify them and add to them and take advantage of opportunities. So that's a very complex framework that we operate for credit. The challenges that we've read about in the press and that have caught the attention of many really relate more to the way that investors have gone to find exposure to private credit, and them finding that they're not being able to withdraw their investment when they've wanted to. That's very different to a reflection on private credit itself, and the investment merits of investing in that part of the market in that way.
So if I can just play that back for you again, just to make sure that I've got it clear. Private credit is absolutely a valued part of an overall sort of credit portfolio. But what I'm hearing is there's just a good deal of caution to make sure you've got the specialist knowledge about knowing what you're investing in and being really careful about liquidity, because this is the big watch out, isn't it? Is where it sits within a bigger portfolio, you can manage that. But if you're somebody who's investing directly, that can pose a real issue. So just be careful how you go about it.
Absolutely. And if you'd like to if any of our members would like more information, we've got a fantastic piece on our advice and resources section on our website, where we've composed a piece that really addresses private credit and explains it. And I think it's a great piece. So I'd encourage members to have a look at that.
Fabulous. Thank you. Now, another question that's coming through, which is a really interesting one, and it's a dynamic that's playing out right now. Fixed income versus cash. I know we had some inflation numbers come out yesterday. Can you sort of help us make sense of what's going on there?
Yeah, absolutely. So let me touch on the fixed interest versus cash. Then maybe I'll come back to the inflation numbers because they were very interesting. Well, interesting to folk like me anyway, but we'll try and make it interesting. Fixed income versus cash. Many of our members have noticed that the returns of fixed income for the past few years have been below the return of cash. And they quite rightly observe that historically that hasn't been normal. Normally, because you do take a small amount of risk in fixed income can go down in value. It does not do so very often, but it's possible.
It's rare. Yeah.
Normally you get a high return for that. The reason for that is because when we came out of COVID, so we're going back about 5 years ago now, interest rates were incredibly low and they've needed to normalise over that time. So now we have bond yields and cash rates that more reflect the historic norms. But the process of that normalisation meant that fixed income didn't perform quite so well, and so cash looked better. That's not necessarily going to be the case in the future. But our thinking about inflation being a little bit high and a bit more volatile in coming years suggests that investors should think carefully about having a diverse set of these more defensive type of investments. So our members can choose from fixed income or cash, or they can even investigate other more defensive but diversified options like Capital Stable, which has got like a broad selection of defensive alternatives as well. But thinking about what the members' needs are is always the most important thing. And everyone is going to want different things from those very specific, more defensive types of investments.
Fabulous. And inflation, hot off the press.
Hot off the press. It was a little lower than the market expected.
Okay.
So 3.8%. Well, it potentially means that the Reserve Bank can pause. There were concerns that we might see another increase, another rate hike. But with those inflation numbers being slightly better than expected, there is a good prospect that the Reserve Bank might hold off.
We can exhale for this month.
We can exhale for this month.
Wonderful.
So we shall see. I think that there's still an expectation that the Reserve Bank is concerned about the trajectory of inflation and getting it under control. Underlying inflation is somewhat elevated as well, but at least it's a pause for now.
Well, thank you, Suzanne. I know that I've got a lot out of that conversation today. I'm sure our members have as well. We have talked a lot today about asset classes and choosing investments. And if that is something that's on your mind, please go to our website. There's lots of resources available, the ones that Suzanne certainly talked about, video about our past performance, but also our team's always here to support you. And we have both resources on the website, and you're able to call into our call centre. And if you'd like, chat to one of our financial planners who can always help with your circumstance. So, Suzanne, a big thank you. We look forward to seeing what happens over the coming year, and we're just really thankful that you guys are looking after our members' money.
Thank you, Kat. Thank you. It's a great pleasure. Thank you.